Hello and welcome. So today we're going to look at Chapter 19 in the textbook, and this is the wrap-up of the first half of the course, which has been focused on financial accounting. So as we go forward from here, we're going to be starting to look at managerial accounting and finance. In an undergraduate course, this would have been a full semester or perhaps 2 semesters. So we've covered a lot of material. And going forward, we'll be doing some different things. And these other kinds of accounting areas are quite different from financial. So financial accounting is about creating financial statements for people outside an organization so they can understand what the organization is doing. Managerial is more aimed at making decisions, so it's used inside the organization to help make decisions. So let's finish up with wrap up the financial accounting now, and then we'll move forward to managerial accounting in the next lecture. So in the U.S., financial accounting is guided by a set of rules called generally accepted accounting principles, and we've talked about these already. And outside investors and credits use this information that's provided to them in order to make decisions. Those decisions might be about granting credit, they might be about investing, they might be about contracting with someone. Are they stable enough to be able to finish a contract? It might be about taking a job with somebody. Should I work for them? Are they going to be there for some period of time? And that information is based on a set of formal standards. And in the last chapter we talked about auditing. The auditor is using those standards and saying, yes, indeed, the financial statements conform to those standards. So where do those standards come from? Well, in the U.S., the Congress, the government, the U.S. federal government, gave the responsibility to the Securities and Exchange Commission to regulate public companies that are selling stock to the public. And the Securities and Exchange Commission said, well, we need to do that, but we're going to appoint a board to do that, and that's the Financial Accounting Standards Board. That's composed of accounting practitioners, CPAs, and academics and industry people, and they work together to create GAAP, generally accepted accounting principles. So that's the United States system. Internationally, for the last 30 years or so, there's been an international system, which is created by the IASB, which is based in London, and it's under the auspices of the United Nations, and they have created a set of rules called IFRS, or International Financial Reporting Standards. So the two systems are similar. They're based off of the same principles, but they differ in some ways, and there's been a movement to make them the same. They call it convergence, and that was started in around 2004, supposed to be completed in 2014, not completed yet, and probably won't be in the near future either. So probably the earliest you might see a true convergence might be 2030, and even that might not happen. So this is actually quite similar, for those of you who are mariners, this is quite similar to the system under the IMO. The U.S. Coast Guard has rules for the U.S., the IMO has international rules, and they're not always exactly the same. To be compliant, you have to comply with IMO rules, but if you're in U.S. waters, you have to comply with U.S. Coast Guard rules. Kind of the same thing. If you're in the U.S., you have to comply with GAAP. Internationally, you have to comply with IFRS. They are quite similar, but not quite the same. So we talked about this way back at the beginning of the course. The users for these things are as listed there: stockholders, creditors, suppliers, and so forth. and the standards need to give these readers reliable, relevant, comparable, and consistent information. So those are the ways that GAP sets those rules. And I think you've learned by now that there's a lot of accounting that is more art than science. So we've learned that, for instance, inventory can be recorded using different cost flow methods because all of them are theoretically correct. Depreciation can be computed in different manners because all of the different manners are theoretically correct. So there's different possibilities for accounting treatment, and theoreticians can argue about those. Different conditions mean that different companies might use different systems and therefore end up with different numbers. So for you as professionals, you need to understand that these rules differ and be able to look at them and understand what rules are being used and what the difference is. So the FASB is the rulemaker for all profit and non-profit organizations. There's also a GASB that makes rules in the U.S. for government standards, and they are changing quite rapidly. Government standards were really almost non-existent before the formation of the GASB, and slowly the government rules are moving to look more like the for-profit and non-profit rules. That'll take some time because governments don't necessarily have to follow rules, so they don't always do so. In both cases, they're called generally accepted accounting principles, whether they're FASB or GASB. As we've learned, there's lots of estimates and unknowns. When we buy a fixed asset, we estimate its useful life and we estimate its salvage value. Our estimates may well be wrong, so figuring out those estimates is important. Just finished reading an article about General Electric's insurance subsidiaries issues, and they sold a lot of insurance policies for long-term care, and they sold those policies up until 2006, and now those long-term care policies obviously take care of people when they're older and end up in nursing homes or needing expensive care, and they underestimated what they thought was going to happen. And at this point in time, they are taking huge charge-offs and spending a lot of time and effort explaining what's going on to their stockholders because their estimates were wrong, and estimates are often wrong. So we do the best we can to make the right estimates, but we're not always right. So all of these rules, have they helped? Are financial statements better now? Starting in 1933, when the SEC was created, I would argue that yes, they are better. They present consistently and relatively fairly. There's less opportunity for fraud than there used to be. There's still opportunity. Fraud is always a possibility. And everything is disclosed. So you guys have looked at some financial statements, done some common sizing. I'm not sure how many of you spent some time looking at the notes to the financial statements, but the notes are extensive. And if you go through all the notes for Kirby or Matson or whoever you were looking at, you would find that there's a huge amount of information there, maybe so much that it's hard to digest, but hundreds of pages of notes, so everything gets disclosed if you're willing, as you, the reader, are willing to dig for it. So the information is there. It's a good system. It could be better, obviously, and constantly there's efforts are going on to work for that. None of these things work if the company is not going to continue operating, and we've talked about this earlier, so I'm not going to spend a lot of time on that. Accountants, the basic tenet of accountancy is conservatism. So if we don't know what we should do, the fallback point is to be conservative. And conservatism is essentially saying we're going to understate assets if we can't come up with a good value. We're going to overstate liabilities if we can't come up with a good value. We're always going to err on the side of showing higher expenses and lower revenues if we can't come up with a value. So that's the conservatism of accountancy, and that's still practiced. Obviously, management may not like that. Management may want to be conservative, but the accounting principles and everything around accounting is designed to be conservative as a fallback point. So you'll see that throughout accounting theory and practice. The matching principle we've also talked about, that we always want to record expenses with the revenue that they're related to. So we don't want to have expenses hidden and reported later, report the income now and report the expenses later, because that will overstate current income and understate future income. So we always want to match our expenses, and we talked about that early also. And cost is the cost of an item that was paid, what we paid for it, or what we gave up to get it. So if we gave up some other asset to get a new asset, then the cost of the new asset was what we gave up to get it. So the old asset. We always want to have objective evidence. So whatever we put on a financial statement should have evidence that's reasonable and that all people can agree on. And that's a tough one. Objective evidence is not always available, but that's a core principle of accounting. Things that are material, things that matter to the reader in understanding the financial statements, have to be presented fairly. Things that are not material, we don't worry too much about. So a $50,000 error on a balance sheet for IBM is immaterial. The balance sheets that you look at are rounded to the thousands or to the millions, so a $50,000 error isn't even going to show up. So not that the error shouldn't be found and corrected, but it's not essential that it be found and corrected. So auditors are not looking for immaterial items. They're looking for items that matter, or material items. Materiality there's no definition for it. It's what matters, and it depends on the size of the organization as to what materiality might be. We want to be consistent throughout. We've talked about that. We want to disclose everything, and I talked about the notes to financial statements that disclose virtually everything. Anything that's going to matter for a fair representation needs to be disclosed. So IFRS, we talked a little bit about that earlier, just a few moments ago. It's definitely a growing moment. The convergence is happening, but it's happening very slowly. The primary difference between the two systems is GAAP is all rule-based, so there's a rule for everything. How do I treat this? How do I treat that? How do I treat the other thing? And IFRS is principles-based, so we want to present fairly, and if it's an asset, we have to do this or that to present fairly. We're not going to make a rule about it. You have to figure out how to do that. So very different thought process went into the two systems, so that's why it's hard to converge them. The relevant, reliable, comparable, consistent statements are the same for both. They both provide a fair presentation. They both use accrual basis. They both have the going concern concept. They both require monetary units of measurement for everything that shows up on a statement. But they do a few things differently. So here's some of the differences. GAAP does not have any allowance for the impact of inflation. IFRS does. It allows adjusting balance sheet numbers, assets, and liabilities for the impact of inflation if the company is operating in a hyperinflationary environment, which they define as anything with a 26% per year or more of inflation for 3 consecutive years. So why does IFRS do this? Well, IFRS is an international system, and there are some countries with hyperinflation, and financial statements cease to mean anything in a hyperinflationary environment. The US GAAP doesn't have to do that because we haven't suffered hyperinflation in our history. So there's a difference. Doesn't affect too many companies that are multinational, but does affect some. The U.S. GAAP has treated some leases as operating leases and some as capital leases. IFRS treats all leases as capital leases, and this is one place where convergence just happened. Recently changed. The U.S. companies are changing their treatment of leases to a system very similar to IFRS, where all leases are treated as capital leases. And you'll see, if you look at financial statements that are coming out as of for the year 2019, that companies are changing their accounting systems to account for leases in a different manner. And there will be notes to the financials saying they're changing their accounting principles to do this. So this is US GAAP converging with IFRS on leases. So that has been a difference that's been converged. LIFO is allowed for US GAAP. You've learned what LIFO is. It's not allowed under IFRS. So there is no LIFO, last in, first out, inventory system allowed for IFRS. Biggest difference that's been really hard to converge is GAAP expenses all research and development costs in the year they're incurred. So if you're developing a new drug and that takes 5 years to do, all of the R&D is expensed each year. Even though that may lead to a drug that will have revenue for 15 or 20 years, we expense all of the research and development costs each year. IFRS allows some development costs to be treated as an asset, so capitalized, and then expensed over the life of the newly developed drug, in this case, in the example I'm using. Really different treatments, and results in really, really different numbers. Or different financial statements. So that's a big difference between GAAP and IFRS, and that's been one that's been really hard to close, that difference, because there's lots of people on each side of the equation there that would like to keep things the same as opposed to changing it. So IFRS doesn't want to change to be more like GAAP, and GAAP doesn't want to change to be more like IFRS in that case. Whenever rules do change, it's very, very difficult for companies because it can change the amount of profit that's reported. It can change how the outside looks at a particular organization, because the profitability and the liquidity and solvency ratios all change because we've changed how we account for things. So when accounting principles change, whether they're changing to IFRS or changing more to GAAP, it may affect contracts, which might be figured on a cost-plus basis, but now costs are changing, so the contract has to be changed. Loan covenants and bond covenants might need to be rewritten because there's major changes, and sometimes employment contracts may be affected because somebody's being paid based on income, and the income number changes because we've changed accounting principles. So lots of implications as we try to converge these two systems. Multinational companies usually prepare their financial statements using both methods. So in the US, they report their income using GAAP, and if they're multinational, they may report income using IFRS standards internationally. So that kind of wraps up financial accounting. That's Chapter 19. There'll be a few questions following this, and then I think there'll be one more lecture this week as well. So thanks for listening, and talk to you later.